Hey guys, Sean Pruitt here, president of Kingdom Exploration. We have a tremendous amount of news. If you're an oil speculator, you're going to love what I have to say here. And so there's been a tremendous amount of geopolitical tensions causing oil prices to go up over $90 a barrel. Now, the thing is, in the past, when there's geopolitical tensions causing oil prices to go up, you always assume that oil prices will eventually come down. But there's news that is lost in the shuffle, which should be big league if you're an oil speculator, and that's the oil infrastructure issue that we have. I mean, we're at 80% capacity right now in the Permian Basin for infrastructure, and it's causing some major disruptions and bottlenecks for the oil and gas industry, and that's going to, geopolitical tensions causes oil prices to rise, spike. But this infrastructure issue is going to cause oil prices to sustain, and I see shale imminently declining. Okay, I'm Sean Pruitt. If you are interested in learning more about the oil and gas industry, please subscribe to this channel. Let's get into, there's an incredible article written by Bloomberg, and normally I write my own summaries and I talk about those things, but it was so well written, and it was everything I needed was in this article. I thought to myself, I'll just read it to you guys. So oil rises to October high as Israel prepares for Iranian attack. U.S. and allies believe retaliatory strike by Iran is imminent. Okay, so oil jumped to the highest price since October as Israel braced for a possible attack from Iran, a development that would threaten major disruptions in a region that accounts for a third of the world's crude output. An assault is expected to come as soon as the next 48 hours, which would mark a significant widening of the conflict that started when Hamas attacked Israel in October. Global benchmark Brent surged as much as 2.7% to top $92 a barrel, a level last reached during the early days of the war. U.S. benchmark West Texas Intermediate climbed as much as 3.1% to surpass $87 a barrel. Israel is expecting a drone and missile attack on government targets within days, either directly from Iran's proxies. People familiar with Western intelligence assessments said the move still hasn't been approved by Tehran's highest-ranking officials. The people said while the U.S. has moved additional military assets into the region, okay, direct Iranian engagement puts higher odds of potential supply disruption in the region, causing many traders to continue to reach for exposure in the crude upside, crude call options. Okay, and so many speculators are betting on crude oil prices going up. Okay, and so before there was short selling, the markets were being short sold by State Street, BlackRock, and Vanguard. But so now there's so many market speculators getting involved now because the negative oil sentiment is over. The tables have turned. Okay. So now you have a lot more stability in the oil markets. Before, when you have control of the oil market, you could just simply buy low, sell high, and do that over and over again and keep making money. Okay. And so right now oil prices have a tremendous amount of upward pressure to where they can't just simply sell off and buy again, okay? And they want to keep it there to ride this price market rally, okay? Direct Iranian engagement puts higher odds of a potential supply disruption in the region, causing many traders to continue to reach for exposure in crude and upside crude call options, okay? And so many people that are speculating in the oil and gas industry to buy futures, they're betting on higher oil prices because they truly believe that Iranian conflict with Israel is imminent. If Israel responds to Iran by attacking Iran, it will cause a tremendous amount of upward pressure on oil prices because it causes a tremendous amount of instability for oil output. I'm telling you right now, if Iran or its proxies respond to Israel, Israel will imminently attack Iran and also its proxies. And 30% of the world's oil supply is in that area. Oil has surged about 19% this year as the Middle East conflict bolsters a market shaped by supply restrictions and stronger than expected demand. These escalating geopolitical tensions, also including the attacks on Russian energy infrastructure by Ukraine, have spurred bullish activity in the oil options market. There has been elevated buying of call options, which profit when prices rise. In recent days, with implied volatility jumping to a 2-month high, the options on Brent are still trading in premium over bearish puts. I mean, there's so many things happening driving oil prices up. Geopolitical tensions between Iran, Israel, the Middle East, and between Ukraine and Russia. Ukraine has successfully bombed Russian oil infrastructure. If you look here, Russia claims massive strikes in Ukrainian oil and gas sites. Russia's hitting Ukraine's oil and gas sites. Ukraine is hitting Russian oil infrastructure, and it's causing a tremendous amount of upward pressure on oil prices, okay? Oil prices surge on fears of imminent Iranian attack, okay? And so there's a tremendous amount of news, as you can see here. The news is infiltrated by geopolitical tensions of what's happening in the Middle East. Now, everyone's talking about the geopolitical issues with Russia and Ukraine, with Israel and Iran, and many other factors in the Middle East. And so there are several things that are getting lost in the shuffle. Now, here's the deal. This is so big. You need to listen to what I'm saying here. Over 80% of oil and natural gas pipeline capacities in the Permian Basin are currently utilized, signaling a bottleneck that restricts further scaling of production and contributes to supply chain volatility and increased market prices. Okay. The oversupply in natural gas production, especially from the Permian Basin, has led to negative pricing scenarios where producers must pay to have their gas removed due to pipeline capacity constraints, underscoring the urgent need for infrastructure expansion. Now, here's what you need to understand, okay? Imagine you have an oil well. Well, the natural driving force of an oil well is natural gas. The profitable part of a well is the oil, but the natural gas is a byproduct of the oil. You can't have one without the other. Now, the natural gas, right now in parts of Texas, natural gas is negative $2 per MCF. In other words, in order to get the natural gas to the refineries, they have to pay them to take it, okay? Because the infrastructure, the gas line is so full. And so these bottlenecks are causing oil companies to flare the gas. Well, because of these overreaching administration, because of the new satellite technology, now they could see where natural gas flares are and they could stop it very quickly, where in the past, it's just too much to regulate. And so now they are reducing their ability to flare gas. So not only is the infrastructure bottleneck preventing them from being able to produce the natural gas at 100%, they're not able to flare it. So what happens? You have to choke your well back, and that reduces your oil output. So now there's such a huge load on the Texas infrastructure that shale companies are having to reduce the amount of oil they output. Now, this causes many issues. Number one, it reduces output. Number two, it reduces the amount of rig activity. Why would you drill more wells in an environment where there's not enough infrastructure? You're just not going to. Now, in addition to that, it's not as profitable to drill. Okay. And so that increases the price of a barrel of crude. Okay. This infrastructure problem is major. Okay. New regulations in satellite surveillance technology are targeting methane emissions severely, limiting the ability to flare excess gas. This constraint is particularly impactful in regions like the Permian Basin, where gas byproduct from oil extraction exceeds pipeline capacity. Despite being the powerhouse of U.S. oil production, the Permian Basin faces severe logistical and regulatory challenges that inhibit its output capabilities, complicating the U.S. role in stabilizing global oil markets. The number of active rigs and the rate of hydraulic fracturing operations have declined, which year-over-year frac spread counts dropping by 30, suggesting a slowdown in new well completions and further straining production growth. Current pipeline capacity limitations not only elevate transport costs, affecting consumer prices, but also raise operational risk as companies navigate the tight margins for increasing output without breaching environmental regulations. So here's the deal, guys. We've got the oil and gas negative sentiment is over. Obviously, the oil price is at over $90 a barrel, makes that clear. The infrastructure limitations that we're having in Texas is going to reduce shale capacity and potential. And even if we didn't have these limitations, shale is on the decline because they have overly developed shale. The quality assets have been depleted. Okay. Now, here's something that the current administration has significantly increased the costs associated with oil and gas drilling on U.S. federal lands, similar to past government tactics used to curb cigarette consumption by cost. Okay. This marks the first comprehensive update to the federal oil and gas leasing program in over 3 decades. Okay. Drilling costs on federal lands have risen from $10,000 to upwards of $150,000. It's a 15-fold increase. Okay. Companies now face higher royalty payments. And so here's the deal. So when you drill a well, the landowners, let's say you're going to drill a well on your land. You own the land, you own the oil rights. Well, in order to drill on your land, the typical deal is you get 12.5% royalty. Okay. And so the U.S. is increasing that royalty. In other words, they're going to get a bigger piece of the revenue from the production of oil, reducing the amount of capital that the oil company gets. It's going to make it more expensive to drill an oil well. If lease costs are going up and you get less of the revenue, oil revenue, that causes oil prices to go up. Period. So the rule aims to reduce the financial burden on taxpayers for cleanup of abandoned oil and gas wells and intends to generate increased revenue for taxpayers by adjusting financial obligations imposed on the oil industry. Now, do you know how ridiculous that is? They're increasing the cost to drill an oil well. They're increasing the cost for oil, and they're reducing the ability to develop oil and gas because these overreaching ESG rules and everything else. They are destroying the American oil and gas industry, talking about cutting off the hand that feeds them. I mean, they're reducing the ability to produce oil and gas by these overreaching ESG rules. They are making it more expensive to develop oil and gas. We have these infrastructure bottlenecks with geopolitical tensions being at an all-time high. If Iran and Israel go toe-to-toe, I mean, right now oil prices are trading at over $90 a barrel. Imagine if the war in the Middle East gets heated even more, or the war with Ukraine and Russia gets even worse. Infrastructure is a major issue. Shale is on the decline. We are in a mess, guys, and grain energy has yet to save us. It's not working out. The current administration lied to us, period. Look at the mess we're in. Oil prices are over $90 a barrel, and here we are coming into an election season. It's not looking good for you-know-who. All right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. If you're interested in investing in oil and gas, go in my description below to learn more. We'll talk soon. Thanks.